Okay, in this video we are going to talk about the different types of annuities. But before we do that, I want to give a little context, a reason, if you will, of why annuities fit, and it all revolves around this word risk. Investors place billions of dollars every year into annuities, just like they place billions of dollars into equity mutual funds and municipal bonds and so forth. And it's all because of this word risk. They're just focusing on different prisms of risk. So let's just talk about the different types of risk and then jump back into the annuities, right? So, and there's more than what I'm listing here, but these are the major ones. So there's interest rate risk, which is basically whatever bond or fixed annuity you have. When interest rates themselves change, it affects your pricing. So think about a teeter-totter. That if interest rates go up, your bond value goes down. And then conversely, if interest rates went down, your bond value would go up. Now, we have videos on all of this, not only in bonds, but really look for the ones for the bonds in annuities. Because not only do we cover the fundamentals of how bond works, but really the intricacies of how they work inside annuity, and it's really, really good stuff there. All right, so the next risk is business risk. And business risk is also known as unsystematic risk. And you'll understand why in a second. So business risk is if you own the stock or the bond of ABC company. So whether you own the stock or the bond, and the company goes out of business or has a labor strike and things just fall through the ground, or they lost there was a lawsuit and they lost, or a patent got challenged and reversed. There's all kinds of things, right? And the stock or the bond value goes down, whether they go bankrupt or just goes down significantly, and you lose a bunch of money or your values drop significantly. That is business risk. And the reason it's unsystematic risk is that there was really nothing you could do about that happening to your individual company, right? You had your $100,000 in this individual company, and there was really nothing you could do to prevent that because you weren't sitting on the board and so forth, right? So that's business risk. The next one is inflation risk, which is pretty easy to understand. Your purchasing power of the dollars you have today, are they going to be able to purchase the same amount in the future? So if a loaf of bread costs you $3 today and down the road it costs $3.70, you want whatever investment you have growing to where you can afford to buy this with the same dollar. So that's inflation risk. Then there's market risk. Now market risk is also known as systematic risk. So obviously converse to business risk, that there was nothing we could do about this. With a systematic risk, we can do something about it by being able to diversify. So what's an example of market risk? Well, I'll give you an example of, let's say the government cuts the defense budget significantly. So then all those defense contractors, whether they're building fighter jets or missiles or whatever it is, they have fewer contracts, less revenue coming in, so stock value goes down, right? So that's a risk. And how do you diversify? Well, with all your money, you just don't only buy defense budget sensitive companies, right? You also have consumer goods companies and pharmaceutical companies and stuff like that, right? So that's the whole point, but that is market risk, which is systematic, and you can diversify. Then the last one we're going to touch on in this video is mortality. And mortality risk, it sounds like a very insurance-y term, but it just simply means that your money doesn't last as long as you do, right? So you basically you're outliving your income. or your asset's ability to produce the income. Okay, so these are the different risks, and I thought this was important because when you look at insurance as an insurance company, right? Because that's who issues annuities. When you look at an insurance company, think of all the different things we are dependent on them in our lives, right? You have a car, what do you have? You have auto insurance. You have a home, what do you have? You have homeowner insurance. Health insurance, even with all the debate at the national level, there's the whole point of health insurance that if we get sick or go to the hospital, that all those bills don't absolutely wipe out everything we've ever earned. And then there's life insurance, whether it's if you're younger and you're doing it in order to replace your income so your spouse and kids can continue on with life, or if you're older and you're wanting life insurance for estate planning purposes to pay the death taxes to your heirs, that's what we do with life insurance. Well, if we're depending on insurance companies for all this, and it makes sense because that's what an insurance company does, is they assess and manage risk. Why wouldn't we do that with our retirement income? And that's really the point of an annuity. And so there's different types of annuities. Let's just jump into these, and then as we go through these, I want to circle back and see how they address these different risks. I think it'll be interesting to do that. So we have a fixed annuity. Well, it's pretty simple. Best thing to think about is that, like a CD, you have your fixed rate. It gives you a declared interest rate, and that rate will not change according to its term. So you can have your percentage interest rate, let's say it's 2%, and if you bought it for 3 years, that 2%, I'll just put a 2 down here, that 2% won't change for 3 years. Now, could it change? Yes, and that's why we have a bunch of different videos under fixed annuities that explains all the different nuances and how these things work in different scenarios. But for just a simple understanding, you have a 3-year fixed annuity, it's giving you 2%, it's going to be 2% for all 3 years, and at the end of the term, then you either renew it or move the money somewhere else. Okay, so fixed for that 3-year period. Then you have the variable annuity, which is the opposite of fixed, meaning that it can vary. The rate doesn't change. Here, your money does change according to what's going on, what sub-account you put your money in. Now, first, is there a fixed bucket you can use? Yes, there's a fixed bucket that you can use, and you can have some or all your money in there if you want to. Most people use a variable annuity because of sub-accounts, and you can have a large cap growth manager, you can have a large cap value manager, you can have a small cap growth manager, you can have a small cap value manager, mid cap, you can have international small, you can have international large, you can have high yield bonds, you can have government bonds, and you can have everything in between, right? So the point is, it works just similar to the mutual funds you're used to. These are not mutual funds, they are sub-accounts, but they're managed like a mutual fund is with a mutual fund manager. Okay, so inside the variable annuity you have a fixed bucket, and you can have all these different sub-accounts that you can get market exposure, whether it's stock market or the bond market. In between is the newest type of annuity called the index annuity, fixed index. It's often nicknamed the hybrid, which I like because it takes the best of both worlds. It gives you a solid fixed rate that's generally higher than the variable annuity fixed bucket. Sometimes it's equal, maybe a little bit less than the fixed annuity, but then you also have the option to grow your money by buying an option on different indices. Most people use the S&P 500, and so the hybrid annuity, just like the fixed annuity, your money cannot go down. It cannot go down. It's always going to be above, but it gives you the option of being in the market and participating according to a cap or participation rate, and obviously we cover that in all the different videos. So these are the 3 different types of annuities. Now there's a 4th category, and that's a category under the immediate annuities, and that is for pure income, and that's where you annuitize your money. And we have videos where we talk about all the different types of annuitization and what that means. You can annuitize a variable annuity, index annuity, or fixed annuity. But what's really nice is all of these products now have what's called income riders. And again, we have videos that exhaustively go through just income riders and how they work. But what the advantage of the income rider is it can get you a guaranteed income stream that you can't outlive. It's not annuitization, meaning the difference between annuitization, when you die, unless you chose a specific option for something to go on to your heirs, then the income stops and the insurance company keeps that because they manage the risk that you might live too long. Using the income rider, you're not annuitizing the money. You can get your guaranteed income stream. When you die, your beneficiary then has options. They can continue the income stream, or they can take a lump sum or a lump sum over a 5-year period of time. Again, go to the other videos we have to explore all this stuff, right? So these are the types of annuities. Let's go back up to our risks, and let's do some positive negative marks here so you can kind of get the hang of this. So on the fixed annuity, well, what kind of risk does it work in a positive way? Well, market risk, meaning if your stock market goes down, well, you can't lose money in a fixed annuity, so we get a positive there for market risk. And also business risk, that's reasonable, that because anything you can lose all your money, just having a straight fixed annuity, there's a positive. But is there a negative on the fixed annuity? Well, sure, interest rate risk, because if you have a fixed rate, for instance, is 2%, and interest rates go up to 4%, and you can get another fixed annuity at 4%, and you're stuck in a 2%, is that not a risk? Well, sure, of course it's a risk. And how would you get your money out? Well, there will be a market value adjustment, which, guess what? Yes, we have videos talking about a market value adjustment, how that works. So we have 2 pluses and a negative on there. Variable annuity, let's go through that. Well, the variable annuity, we certainly get a plus for inflation risk, right? Because we have the ability to use these sub-accounts and make the money grow over time. And with these income riders, we can address the mortality risk, right? Because we can get that guaranteed income stream even on a variable annuity, right? What about the negatives? Well, the big negative you're going to have here is the market risk, right? So let's just look at, I'll just write this down. Yes, you can diversify, and you can certainly diversify into sub-accounts, but if we have another 2008, that's a big risk, right? And so there's you couldn't even diversify away from that type of risk because everything went down. All right, so let's go to the index annuity, and let's see what there we are. So we have, just like the variable annuity, we have a plus mark on inflation risk because we have the upside potential that our money can grow, and we also have a plus sign for market risk. Why? Because our money is not in the S&P, we're buying an option on the S&P. So if a 2008 comes along, are we going to lose money? No, we're not. So we avoid that market. We're addressing that market risk, and so we avoid that. What about business risk? Well, again, if something goes down in value, we can't lose money in the index annuity, even though we're trying to get some upside, so we get a positive there because we're addressing that. And the mortality risk, we get a plus for the mortality risk because the index annuities have phenomenal income riders that you can get that income stream you can guaranteed. Is there a negative? Sure, you bet. There's an interest rate. We have to put a negative there for interest rate. Why? Same way, in the index annuity, remember we have this fixed rate, so we can get a fixed rate in there. Well, if interest rates go up, you could get a higher fixed rate in another annuity, and therefore you have some interest rate risk there. Okay? All right, so hopefully this helps. I know we covered a lot of ground on this, but I thought it was valuable ground to not only talk about the types of annuities, but the reason for them according to these different types of risk, and hopefully this made sense to you. Okay? Thanks for watching.